And now, in studio, bringing his Midwest values from the Show Me State to the land of San Diego. He's a triple threat, licensed as an attorney, mortgage broker, and a top producing realtor who's crushing the competition. Here to deliver you what's happening in the trenches of the market. Your host, Michael Gaddis.
Welcome back to the Michael Gaddis Show on AM 1170 The Answer. That was a fun first two segments. I really enjoyed it, and I hope everybody really took the time to listen to what I had to say, because I'm telling you straight from the heart, there is a difference between real estate professionals. They are not all created the same. I assure you they're not. Anyway, I'm going to switch gears a little bit. I want to talk about my favorite topic, reverse mortgages. I love reverse mortgages. And I want to share a story that that happened to me this last week. This last week, I got a phone call from an 80-year-old lady who lives in Oceanside, California. She told me that she has begun the process of a reverse mortgage with another company, and she was feeling uncomfortable. They were pressing her really hard to get the appraisal. She was she was really putting a lot of pressure on her, and she says, "Look, I don't really understand what's going on. I've tried to ask them questions and they haven't responded, or they're glossing over my questions like they're not important." She goes, "It really concerns me, and I really need a second opinion. I really need to know if I'm getting a good deal." She goes, "I don't have a lot of assets. I don't have any family." She says, "I don't have a lot of money in the bank, so my house is all I have, and I need to make sure I'm making the right decision." Now, when I went through her initial, before I reviewed this proposal that the other company had given her, I kind of went through her finances, and she's on a very tight budget. She's on a fixed income, a Social Security, and a very small pension. So she doesn't make a lot of money. Right now, her house payment, her principal and interest payment on her house is $1,100, and she takes home about $1,750, almost $1,800 a month. So basically the house is consuming almost everything that she has, the payment. So she was scared because she feels these guys are pressuring her. They're not explaining things to her. So she said, "Michael," she said, "can you look at it?" So I said I would. So she sends me over the proposal that she received from this other company, which I will not name. It took me maybe 30 seconds, I'd say maybe 30 seconds, to realize that she was not basically getting the best that she possibly could. And it was by a long shot. One of the things I noticed, the first thing I saw, was that they gave her a margin of 3%. Now, anytime she gave her an adjustable rate monthly mortgage with a margin of 3%. Now, I had a workshop last night, a reverse mortgage workshop, where I had a few people there, and I confused them when it came to margins and indexes. It took me about 30 minutes to kind of really explain what a margin is. But let's kind of cut that down a little bit, and safe it to say that a margin of 3% is not really in your best interest. So, and there's a reason why. Because when in a reverse mortgage, many times when you get a margin of 3%, that means that your eligible principal balance goes down some. And that is exactly what happened in this case. I calculated her eligible principal balance, and if you remember from my previous shows, an eligible principal balance is determined by the fair market value of your house times a factor based upon your age. So I believe in this case it was 60, I can't remember the percentage actually, I'm not even going to guess what the percentage was. But it's a factor based upon your age. So I calculated that out, and I figured out where her, basically, and I'll tell you, basically they had a principal limit on their estimate of $159,258. It should have been about $167,000. So somewhere $8,000 was missing, and that was missing because basically the 3% margin was there. Now, why did he put a 3% margin? Because he's paid more. Let's just take the elephant out of the room. He was paid more for giving her a 3% margin. That's why he did it. So I knew immediately that this was not in her best interest, because you could have kicked her margin down to like 2.875, and that eligible principal balance would have gone up by $7,000, and it would have increased her line of credit down there at the bottom, which we'll talk about in a second, by $7,000. So that was the main thing that really concerned me. I was like, wait a minute, this guy's not taking into consideration the fact that this 3% margin is cutting into that eligible principal balance, which is going to affect an 80-year-old woman who's on a fixed income with basically very, very few reserves. So I looked at it a little bit more, and I noticed that he was also charging her origination fee. And I can assure you that in these cases, I do not charge an origination fee in situations like there's no way. The woman, first of all, she's 80 years old. Second of all, she has an existing balance on her loan. So basically, I get paid from the bank. And I knew that I was getting paid from the bank, so I don't need to charge somebody like this on the front and the back. It's perfectly well within their right. It's perfectly legal to do that, but I just don't. And because one thing is, it takes away from her line of credit, and she needs as much line of credit as she can get. So that's $2,500 plus the $7,000 that that the 3% margin caused the eligible principal balance to drop. So we're talking about a $9,500 already out of her pocket from her line of credit just from doing this. So I said, well, wait a minute, I'm going to give this guy a benefit of the doubt. Maybe he gave her a credit for closing costs because he gave her a 3% margin. He's getting paid more, so maybe he's giving it back to her. But then I thought, why would he charge her origination and then give her a credit? And sure enough, I look at the next column, nope, zero credit. So 0 credit, 3% margin, and her eligible principal balance has been reduced. So, and then I look down at the line of credit, and her line of credit is basically, after she pays off her note, her existing loan, she will have a line of credit of $6,564 according to this. Now, if she were using me, her line of credit would be almost $10,000 more than that, just by me changing a couple numbers around. And so I looked through it, and I knew that this, as I said, this is not necessarily an illegal thing. They have the right to give a proposal like this. What I'm telling you is you need a second opinion sometimes to make sure that you're getting a good deal. Because as I said, someone like myself can look at this and within 25, 30 seconds know, hey, there's some issues here. I could really give you a greater benefit than you're getting out of this just by moving some numbers around. And that's what she needed. This is not somebody that, this is all this woman has in this world. And for somebody to sit there and go, oh, I'll just crank up the margin and I'll charge her origination on top of that. That's not how I roll, and I don't suggest that, that the rest of you allow that to happen. So anybody out there who is, who is considering a reverse mortgage, who might have a proposal on the table right now, it doesn't take me long to review it. If you want to send it to me just to look at and see if you have a good deal, I'm not trying to steal people's deals. I'm not in the business of saying, oh, I'm going to try to. What I'm trying to do is make sure that you're getting the best benefit that you can from the reverse mortgage. And, it concerns me when I see this because, this person is a very nice woman. And she's very confused. And she's feeling a lot of pressure. And it doesn't need to be like that. It could be a lot smoother transition. And when I showed her, I prepared a competing proposal. And when she saw that proposal, she was like, wow, this is different. And I showed her how the columns were different and where they were different. And the main one she was worried about is the amount of her line of credit. They had put $6,564, and mine was considerably higher. And that's what really astounded her, because that line of credit is basically her funds for the future. And the great thing is, if you've listened to the show before, line of credits grow. So, like for example, the line of credit can grow anywhere from 4.68 to almost 5% per year for unused portions of the line of credit. So, since we eliminated this woman's her mortgage payment, that alone allowed her to live a more comfortable life. So what I told her is, look, don't tap into your line of credit unless you absolutely need to. It's there, but don't use it like an ATM machine. Save it for when you really need it, because every year that you have it, it's going to grow. So then by the time you really do need it, there's going to be more money in there than there is even now. And since there wasn't enough room to give her a giant line of credit, it's a great opportunity for her to let it grow. And you know what she told me? She says, Michael, she says, I don't, just the fact that you've eliminated my mortgage payment alone is going to change my quality of life. She goes, right now I am literally stressed every single day I can't go out to eat. Sometimes I buy groceries and then I run out and I don't have enough money left over to do it without putting it on credit. And to be honest with you, I don't want to put it in credit. I don't want to put myself at 80 years old in a bunch of credit card debt. So, you know, this woman now is going to have the ability to go out to eat. She could go see movies. She could, you know, go anywhere she wants to go. So I only tell you that story because I firmly believe that, you know, you should get a second opinion. And if you're not feeling 100% comfortable, there are other agencies or other brokerages like myself that are able to look at your situation and at least give you an opinion. You know, whether you end up still using the first company or not, that's great, whatever. At least you're going to hear my opinion on what I could do to, you know, to try to make it better, if there's a way to make it better. And there's a lot of ways you can to minimize closing costs, things like that. In fact, that's what we're going to talk about in the next segment. So after the break, we're going to talk a little bit about how you can minimize or actually eradicate all of your closing costs in a reverse mortgage. You're listening to the Michael Gaddis Show on AM 1170, The Answer.